Hi, everyone. This is Robert Keens with goldsilverpros.com. And today I have a very special guest for the program, Kenneth Ameduri, who is the chief editor and co-founder of the financial publication letter CrushTheStreet.com, which is focused on trend investing and sound money. Kenneth, how are you today?
Hey, Robert, doing well under the circumstances. Quite a different world that we're dealing with at the moment. Obviously, this pandemic that's going on and just the way the world has taken this, and all of us listening to the government the way we are doing is quite the experience and quite the social experiment, I will say.
Yeah, I agree. I don't know that I've seen anything like this in my lifetime. I don't even know if this compares to the Great Depression era, because it's just completely different circumstances. Really interesting.
Different.
And that's a good topic to start off with. I wanted to start talking to you about COVID-19 and how you think it's impacting the economy with all these shut-ins and shutdowns.
Yeah, and I will agree with a lot of the people that have said that this is the pin that pricked the bubble, but really it's more of like a bazooka that hit this bubble. When you think about how severe this slowdown, this shutdown is, billions of people in their homes being told not to go to work. And, already, our economy was running on fumes in terms of, extreme stimulus, extreme artificial injections of manipulating people's behavior. When you think about it, we have guns to our head to go out and spend money with negative and low interest rates. Like there's no, this is not real. People should have savings. And, we're seeing the results of that in this pandemic. People don't have savings. And as soon as things turn, it's a massive crisis. I mean, we see large corporations going under. I think 100 companies on the S&P 500 suspended dividends. That's a fast number, a massively big number, and happening so fast, going from the greatest boom seemingly to this bust. It just really shows the vulnerabilities of our economy. And, there's a lot of talk out there as to how serious this virus is, if they're manipulating the data, if it's to be trusted, if they're massaging the data, if there's more COVID-19 patients that are being reported as dead that, we really should believe. All that stuff is out there. And, it's a question of, are they trying to instill fear in us? And, will this usher in greater socialism, which I think it is. I mean, I've said that in the past, that the next crisis will be an ushering in of greater socialism. And, even those that think they're, more conservative, during this pandemic are reaching out for their $1,200 stimulus check, or, small businesses wanting their paycheck protection program. They're all opting for this type of socialism because, hey, they want to be a part of it too. And I think that's a problem. I think it's a problem when ADP announces 20 million private sector jobs lost in the month of April. You have this contraction of the private sector, the public sector getting bigger. We hit 25 trillion on the national debt. Like yesterday, I think the national debt clock crossed 25 trillion and went through 24 trillion in like a matter of seconds. And so we're really growing exponentially in terms of, what it's taking to keep this economy going. And that's unsustainable. Just think about, a lot of people say, hey, this might be the end game. I think they're going to be able to paper over this with an extreme amount of printing like they're doing. And let's say they do, but what does the next crisis look like? What are the reactions going to be the next time around? And maybe they're not able to paper over this. But you got to be prepared for that. And you got to assume the inevitabilities of a decreasing, devaluing US dollar and global currencies around the world. And that's where we're at. The conspiracies, this bubble talk that we've talked about, during the boom, during 2019, 2018, even the 2008 financial crisis, that was just a speed bump to the main event. If you think about it, this is mainstream headlines now. That's what it's becoming. It's becoming mainstream headlines. And I think people are waking up.
Yeah, I think they are as well. And to add to one of the points you had there, There's a study done last year that showed that 40% of Americans didn't have $400 or couldn't handle a $400 additional expense to their monthly income. And that really talks about where a big chunk of people are in this economy. And now you have the shutting down of restaurants and jobs that people relied on, to feed their families and pay their rent. And I can just see this reverberating throughout the economy. It's not only going to hit the restaurant sector, eventually it's going to hit real estate, lack of paid rents, for example, and eventually it's going to hit the corporate books and lack of spend on new products and services. I wanted to ask you, what's your view on what will happen to stocks in this situation? Say the Fed bails us out with just trillions in new money. Are stocks going to keep going up, or what is your view on that?
Yeah, it's an interesting dynamic that we have right now. And just to touch on what you just said there, I mean, this 30 million figure that they've announced in terms of people filing for unemployment here in the U.S., a lot of this has been delayed. The pain of the fundamentals in the economy haven't really been felt yet. And a lot of people on the lower end of the earnings spectrum are arguably doing better than they were when they had a job. They're getting their $1,200 check per person plus $500 per kid. Maybe they're getting unemployment now, which has got an extra bonus of the $600. So they're making more money than they were when they had a job. So, call it the bottom end of the spectrum is feeling good to a certain degree. And they're throwing trillions of dollars at it. The stock market has recovered some. April was one of the best months since like 1987 in terms of like a rebound when it came to stocks. And so there's this feeling of optimism, and it's all been this delayed effect because of what the federal government has done and the Federal Reserve has done. And I think, they're going to take it to the next level. They're going to probably announce the biggest infrastructure plan our country has ever seen to rebuild, freeways, bridges, and, everything, airports, all these different things, just to get these people back to work. And again, it's that debt mentality, and they might be able to string us along here. But because, just like you said, things haven't flushed through the system yet, I don't think there's a lot of upside in the stock market at the moment. This needs to play out. The defaults need to happen. People need to, unfortunately go through the process of losing their homes that they shouldn't have been able to afford. And now their lack of income with their renters or what have you, their lack of income because of their job when their unemployment runs out, there's going to be dead weight on the economy. And these bankruptcies are going to have to flush through the system. Now, to the extent that the federal government and the Federal Reserve are going to prop up the stock market, I think that's very likely. When you look at the M2 money supply from 1959, it started at $250 billion. Today, it's around 16 trillion, and that's not counting everything that just has been implemented and injected into the system. But if you look at that, that's a 52 times increase in the money supply, which works itself out to 6.7% annualized year after year. And it just so happens to correlate with, what the stock market returns every year and what real estate returns every year. So you have to assume that this money is going to flow back into assets at some point. And, to the degree that they're injecting trillions of dollars, it might do it to a larger degree. And I'm not saying it's going to be in terms of purchasing power per se. And, also keep in mind, it's rare that the stock market ever moves up that 6.7% in 1 year. That's just the average. Usually, I can compare it to, putting your hand in freezing water and boiling water, and then, saying the average is warm. That's what that 6.7% annualized return is like, describing, jumping into the stock market at any one given time. That's your risk, these extreme booms and busts with it. But over time, I do believe that they will go higher. I don't see there to be a lot of upside in the near future, though, with a lot of the bad news that needs to flush through the system, and we're going to see that for an extended period of time. and this stimulus needs to, ultimately wear off a bit. People need to go through the defaults, and this bad news is going to weigh on stocks.
I think it will too. I think one of the beneficiaries will be gold. And it's interesting you mentioned before that when you compare the inflation of the money supply, you can put that side by side with the growth in real estate and stocks. And that coincides with the studies I've done, that if you discount out inflation out of stocks, that the returns haven't been nearly what people have said. So even if you're investing in stocks long term, you're just barely beating inflation. You're not really beating it as much as you think you are. One investment that has been beating inflation pretty soundly, especially since 2000, is gold. And gold has just basically wiped the floor with all the major stock indices, the S&P, the Dow, and the Wilshire. What's your view on gold? Is that a true safe haven? Or are you a fan of gold at all?
I love gold. It really is what led me into, starting my newsletter, just seeing the exposures of the economy, the misinformation, if you will, that has come from the mainstream media. And a lot of these things that we're talking about now have been headline news, but everyone's shocked by it because no one was talking about the debt and the deficits and the problems and the fundamental problems. And so, I like gold a lot. We actually wrote a special report at crushthestreet.com/gold book, which kind of goes through our philosophy on gold, which people can download for free there. But when it comes to what we're facing now, we're going to see, real negative rates. It's going to be this environment where people are going to look for returns, which is why they're going to buy stocks too, unfortunately. But gold has a historical precedence of retaining purchasing power. And it's, again, in those boom and bust times. I mean, you can always look at a chart and say, okay, well, over time, if you annualize it, I really think we're in that acceleration phase where we'll see a massive move in gold in this, extreme bust time. And, as the world continues to, and global central banks and governments, they continue to direct people into cashless societies, trying to keep people in US dollars or certain fiat currencies. I mean, this is a problem. Gold is a competition. And I think people are going to want that opt-out opportunity, that opportunity to get into something that isn't just centrally controlled and can be, inflated into oblivion. I mean, my goodness, what Neil Kashkari admitted on that interview, that, we are going to overreact, to this situation. We're going to print, unlimited amounts of money. It really goes to show how fragile the US dollar can really be. And I think looking at even oil, what we saw last month with oil going negative, we saw what it's like for markets to break down. Mainstream headlines. That's like a realization moment that this is possible. It's not conspiracy. You know what I mean? And so when you see stuff like that, it makes the case for gold so much more powerful. And, I think gold is a great place to store your wealth. I think stocks will, do their thing in relation to the dollar. But I think gold is the place to really outpace the crisis, that is brewing in the underlying economy. And that's, and we're seeing that, the fact is gold was $1,200 not that long ago. And here we are at $1,700. And if you actually wanted to get it, it's probably closer to $1,850, $1,900, because of the shortages. So I'm a fan of gold. I've been buying for many years. I think it's a cash position. I see it as a cash position, a liquid position. And so I highly recommend people to look at gold and to have it as a core allocation in your portfolio.
Switching to other alternative investments from the stock and bond markets, traditional investments in the US, a lot of younger investors are turning towards the cryptos, especially the millennials. What's your view on the cryptos? Do you have a favorite one, or do you follow Bitcoin or Ethereum?
Yeah, we were fortunate to cover the crypto space early on, which was Bitcoin. Back in 2012, 2013 was when I first started to look into it, get into it. and we created Banker's Worst Fear. It was a documentary in 2013 about the crypto space and kind of what it was to the system. And maybe there was a little hyperbole in there and whatnot, but we're seeing that happen. We're seeing a real competitor to fiat currencies, and I think that's a powerful thing. I mean, it was brewed out of the 2008 financial crisis. And, for people around the world who aren't in the US or Canada or some of these other countries which have, a little more stable currencies, they've really benefited from something like Bitcoin. They've seen their banks lock down their accounts and inflate their currencies and see it fall against, other currencies, hyperinflation take place. So Bitcoin has been a real solid alternative for people who've experienced tyrannical governments. And it continues to prove itself. It's limited in supply. And I believe there's a lot of value in the network of people supporting it, the transparency, the anonymity, the trust that comes in the Bitcoin network. But it's still very early. It's just a little over 10 years old now. So it's volatile. It's a small space. It can move very fast. And all of the concerns that a lot of people have are the same reasons why I didn't put a lot more money into it. You know what I mean? Like I get it too. It's new. What if something else comes and replaces it? But the longer I witness what is happening in Bitcoin, the more I think it's the dominator. It's not going to be uprooted easily. I mean, there's a network effect that is being brewed that is not going to be easily usurped. I mean, think about the English language around the world. How difficult would it be for the world to start commerce and change how it transacts by just changing the language? There's a lot of cost that goes into it. I mean, it's just going to take years and years and years. And so the network effect that's established in Bitcoin is something that I think people undervalue. And with this halving coming up, you have a quantitative hardening in the monetary space that is historically very, very good for Bitcoin. And we're seeing that right now. I mean, Bitcoin has recovered from the crash that it saw with everything else. I mean, even gold came down a little bit when we started seeing stocks crash, that liquidity, everything crashed moment, margin calls, flight to US dollars. Bitcoin's more than recovered. We're back to that 9,000 level plus now. I think it was 9,500 this morning as the chips started to settle. And I think that's what's going to happen. It might experience these crashes, with overall market sell-offs. But as the chips settle, we will see Bitcoin continue to see new highs. I don't think it's unreasonable to see all-time highs broken this year or into next year. And my personal target is that we will see Bitcoin $50,000 in short order.
Yeah. I know there was a really big run up in the world cryptocurrency total market capitalization of all the world's cryptos. And I believe it was January 2018, it reached over $750 billion. I know the mean has been, the last 3 to 4 years has been about 250 billion, but that just speaks to the scope of the amount of investment going into these cryptocurrencies, not only Bitcoin, but Ethereum and Litecoin and some of these others as well. So I definitely think it does speak to people waking up. And so you can't just look at the gold price and say, what is the faith in the current monetary system in the US? I think you also have to look at the cryptos, kind of put those together, and that's really your barometer. And it's actually kind of encouraging to see people getting into alternative investments, whatever you think of gold and Bitcoin individually, just to show that, there is a general lack of faith in the US dollar. Want to get your thoughts on, what are the chances that if we have like a deflationary depression, if we go that far, will the US dollar fall as a reserve currency? And if so, what do you think could be an alternative there? Do you think people will turn to the cryptos or gold, or what's your thoughts on that?
Yeah. If I could make a comment on what you were saying before, I think Bitcoin is an ally to gold in a lot of ways, because, Bitcoin is a decentralized, currency that's on the internet. And, it reminded me of what's going on this week with that movie Plandemic. It's going viral. A lot of people are watching it, and it just keeps getting shut down on every platform. but then
Mm-hmm.
it just keeps getting uploaded by somebody else because there's, millions of people around the world and you can't just control that. You know what I
Mm-hmm.
mean?
Right.
And so the internet is the great equalizer. Agree with it or not, whether or not you believe in that movie, but it just shows that the narrative that was once really centralized is very difficult to control now, and people are being exposed to the fact that the mainstream mantra could be altered, lies at times, or massaged. And so I think Bitcoin is exposing that in a
Mm-hmm.
lot of ways, and I think that's going to be beneficial for gold. So I just wanted to throw that in there.
Mm-hmm.
And as far as the US dollar goes, you have to assume that, in relation to other currencies, because the rest of the world is acting in unison with the US, it could be the cleanest shirt in a basket of dirty laundry
Mm-hmm.
for an extended period of time. And that's what has me believing that we're not going to experience hyperinflation in short order here,
Mm-hmm.
because the rest of the world is doing the same thing. And even if the US is trashing the currency and inflating it, we're still going to see that rush to US dollars as a safe haven. Maybe for an extended period of time. I think what happened with China, with this coronavirus, people are going to question China. There was a lot of excitement to say, hey, let's go invest in China, the growth that's happening there. But I think investors are going to be scarred for, the next 5 to 10 years. Companies are going to question manufacturing,
Mm-hmm.
everything in China. They might say, hey, well, we got to pay a little more here in the US, but we're going to do that because we don't want our whole entire exposure in China. We're seeing the failures of Europe in this moment. So, where else do you go when it comes to conventional investing, conventional fiat dollar investing? So in terms of other countries, I think the US is going to fare okay, to be honest with you. But in terms of real purchasing power, we could see the dollar get stronger in
Mm-hmm.
this environment against other currencies. But I think gold is going to move up as well and outpace it. I think it's going to be this continuing separation of the rich and the poor, unfortunately, because those who have assets are going to see those assets increase in value. And for those who don't, the world's just going to get more expensive on them. And that's what we're going to continue to see. Goods are going to continue to go up. And it's going to be this, growing of the government as a percentage of, the private sector that's going to continue to put a stress on the system. But, to the degree that we're doing this all around the world, that's the only saving grace that the U.S. has, is that everyone is acting in this way. If we had some more prudence going on in other countries as well, I could see them, gaining traction, fundamental traction. But unfortunately, that's not what we have. So I do see the potential for, the U.S. dollar declining against other goods and services, gold and silver and stocks. But that's the competition. It's not other fiat currencies.
Yeah. Last question for you. What else would you like to tell the viewers? What do you have going on at Crusher Street, and what's next for you in terms of what you're covering?
Well, right now, this is a time to be resilient. And, in this shift of, February 2020 being this massive boom, everyone wanting to chase yield and cash flow and really excited about the economy, into a real turn on a dime, it really goes to show the value of having resilience in cash and just preserving wealth, not even getting ahead, just preserving. People who are preserving their wealth right now are getting ahead for those who are losing everything. So there's something about just having a sound financial position. So I think cash is going to be key right now. I don't think you need to act hastily. When I say cash, as I said earlier, I believe gold is a cash position. So some US dollar cash is good. A gold position is good. And over the next 12 to 18 months, we're going to see a flushing out of the system. And I think we're going to see some opportunities here. So if you're not in gold, I think that's an opportunity right now. The silver silver play right now. I mean, we're seeing some historical numbers in terms of the gold silver ratio. Everyone knows the phrase gold moves first, silver moves further. That's historically true. And I think that's going to happen, and I'm betting on it. I think silver right now is, a really big opportunity, a great opportunity to be looking at. So if you don't own any silver, consider silver. If you want a special report that we wrote at Crush the Street, go to crushthestreet.com/goldbook. It's a free report. I highly recommend people to go there and check it out. But yeah, Robert, thanks for having me on the show. Appreciate it.
Absolutely. Thank you so much for coming on, Kenneth. It was an absolute pleasure to speak with you today. Would love to touch base with you again.